All right. Happy Monday. Hope you guys had a great weekend. I text Matt here and make sure that he's in. And as soon as he's in, we'll pull him up and he's got a nice presentation for you guys. Able to get on call for Discord. Okay, he says he's in. Cool. All right. Yeah, if you'll just request Matt and I'll pull you up here and we can hop in to the rundown here. So again, appreciate you guys taking out time on a Monday. I know the inauguration is live right now, and it is a holiday. Happy Martin Luther King Day. Hope you guys are enjoying that. And let me get over here in the chat. I'm sorry. There we go. There he is. Cool.
Hey, good morning.
Morning, morning.
How y'all
You're
doing? You can hear me okay?
yes, sir. Good on my side.
Awesome.
And this is recorded for those that are concerned on that side. We will have it listed over there in the All Recordings channel. Max hopefully will get that up at some point today for those that want to listen back to this later or want to re-listen to it again. If you have questions about what Matt has to say, I'm going to give him the floor and just let him run through the full presentation of what he's been able to put together with Max Con on compliance over there to talk about the opportunities that we have at Digital Wealth Partners to be able to earn yield on the assets held there. Um, Please hold questions till the end. If you do want to place them over in the chat, we will try to go back through them. But yeah, if you could hold them to the end, or just write them down somewhere so that you can add them, we'll knock them out at the end of the presentation. Oh no, we lost him. There he goes. Um, so without further ado, Matt, are you have the capability to share screen and walk people through the presentation here?
Can y'all see my screen? How's this looking? All right, we're on here. Let me see if I can change this. Let me get out of here. Uh,
The never-ending mirrors.
yeah, sorry, I'm just trying to make sure that I can get this set up the right way here.
Yep.
Um, I promise I presented a thing before. Now I've got like
You have.
scripts and I've got all these. Yeah, I have.
He's done it a
Let's see.
couple times in here, which has been great.
Yeah, apologies for the delay. Okay, share this screen. How's that?
Perfect.
Does that look okay?
Yep.
Okay. All right.
All yours.
I can come down to the. All right. You can see this change here.
Yep. Looks good.
And we talk about the agenda.
Looks good.
Okay. Amazing. Well, hi, everybody. Thank you so much for being here and joining us today. Again, as Jake said, happy MLK Day. I know it's a holiday, but we really appreciate you joining. I'm very excited to speak more about the investment offerings that we're working on here at Digital Wealth Partners and that we've been working on for the past couple months. My name is Matthew Snider, for those of you who don't know me. I'm the Chief Investment Officer of Digital Wealth Partners. And some of you may have met me in person. Some of you may have met me via client discussions or online. But in any case, it's great to connect with all of you here. And we really thank you for all your support for the work that we're doing here and being part of this adventure. We're really excited about it. On our agenda today, we're going to talk about three main topics here. The first is suitability and how we at DWP evaluate the right investments for you. And I couldn't get away from talking with folks without giving a short financial lesson here about the difference between yield and returns and how they pertain to the strategies that we'll be discussing. And finally, we'll discuss our investment offerings that people are eager to discuss and the two key strategies that we're trying to put together here to achieve some additional goals that you can use with your XRP. So as Jake mentioned, if you have questions, please add them to the chat and we'll have the team take these in for discussion after the presentation. Before I really get kind of rocking here, I just want to make a big blanket note and statement for everybody that I'm sure you're all very aware of, which is crypto is risky. There's nothing that we can really get around here in talking about that. It's a volatile asset class and the potential for complete capital loss does exist. That said, with risk comes opportunity. And our job is to evaluate your suitability carefully and ensure that the strategies we recommend align with your risk tolerance and financial goals. So, with that, as fiduciaries, we take suitability very seriously. And here's how to approach it. Understanding your financial goals is the top priority for us, and that means start having a conversation with you about learning what you hope to achieve with your investments, looking to see if you're seeking growth or income, a preservation of wealth, a mix of any of those. And what your horizon is from an investment perspective, whether this is short term, mid term, long term, et cetera. We also look to assess your risk tolerance here, and we evaluate your comfort with volatility and how quickly you may need access to your capital. We also determine your eligibility. Not every investment is right for every investor, and eligibility plays a critical role. So before we are able to place you in strategies, we need to ensure that we abide by the rules and regulations with respect to these offerings and make sure that they fit with your personal profile. Next, we match you with opportunities. And it's important to highlight here that this is just a subset of what we're planning to offer at Digital Wealth Partners in the coming months and years. These are the first kind of couple ones that we're going to be launching for folks to participate in, that will be very exciting. But we're, as Jake, is always making sure that I'm aware of what's next. What other things can we do here to provide creative solutions for folks and provide additional ways for you to put your capital to work. So on the long haul of being a part of DWP is getting matched with those opportunities on a regular cadence. And then finally, we have regular check-ins with your advisor. And these are important because as circumstances change, we want to ensure that your portfolio evolves with you. Suitability here is not static, and we'll reassess periodically to ensure that the portfolio that you have remains aligned with your needs. At the end of the day, decisions to participate in these strategies is still yours, but as professionals, we must ensure that you are aware of the associated risks. Also, one note here, there's been back and forth, both on our side and within the community about the requirements for these strategies. And based on our research and discussions with internal and external legal counsels at length, part of participating in these strategies involves being an accredited investor as defined by the SEC today. There are mechanisms where this could potentially change in the future, but this is the status of where we are currently. And this means, according to the SEC, that you would have to earn $200,000 annually or $300,000 with a spouse for the past 2 years and expect the same this year. Additionally, or it doesn't have to be and, I don't know why I said and, or you can have a net worth over $1 million, excluding your primary residence, or you can hold professional licenses like the Series 7, Series 65, like I myself and our other advisors have, or the Series 82. For businesses that are entities involved with DWP to qualify as accredited, all members of that entity must be accredited as well. Moving forward to our small financial lesson for the day, I want to take a moment to introduce a nuanced difference between yield and returns. And this comes as I know that there's a lot of discussion about yields on products versus returns on products. And we just want to make sure that you have as much information as possible and we make a clear distinction between the two. And in order to do that, let's first look at what yield typically means. When we talk about yield, we usually looked at things like fixed income investments. And these are sometimes derived from things like interest-bearing bonds, stock dividends, or structured products, where there's a fixed outlay of capital that is going to be returned to an investor. And these typically have much lower risks associated with them than additional investment opportunities. When we look to the strategies that DWP is going to offer, these should be looked at in the form of returns, where we have variable income of using different kinds of instruments. And sometimes these income sources are derived from stocks or real estate or even staking and liquidity pools. And in most instances, these risks are typically what we would call medium or higher risk over the, I would say in terms of like yield, they're a little bit more of a higher risk strategy. So when we talk about what DWP is offering today, they are focused on returns. These two strategies will generate returns, potentially using income-based strategies, but they will produce returns on your portfolio, and they will not be generating quote unquote yield. However, those are things we're working on, as I said previously, about matching opportunities to you, and we're hoping to offer yield bearing opportunities here in the future. So I just want to make sure that we are aligned there from that perspective. Moving forward, I want to talk about how Digital Wealth Partners differs from traditional bankers offering similar strategies. And before anybody puts a question in the comments, I do want to say that yes, this is an AI generated picture of Jamie Dimon running away from a logo of XRP that I created this weekend. I thought it would be apt for this conversation. I hope you enjoy it. Traditional funds often have very high barriers to entry, like minimum investments, typically above 5 million, approaching 10 million, potentially more. They have management fees that are pretty standard in the industry, 2% for management and 20% for performance. They also lack additional benefits for additional services that we'll talk about in a moment, but they also have typically higher minimums for people to participate. So just because you may have $5 or $10 million in liquid capital that you could put to one of these strategies, you may not want to do that whole thing. But at the very minimum, limited partners are typically required to put in $200 or $400,000 or $500,000 even to participate. And what's more, you're not going to get access to a pipeline of additional opportunities for new strategies that might come up. And they're certainly not going to necessarily provide custody or investment advisory or estate planning. And so I think that that's just an important thing to point out. At Digital Wealth Partners, we feel that we're unique in this space because we're passionate about redefining wealth management for the digital age. And our goal is to meet you where you are in the digital ecosystem by leveraging blockchain technology, cryptocurrencies, and cutting edge strategies to put your assets to work effectively. I'm incredibly proud of what we're building here. And it's not just innovative work, but it's transformational in terms of how people participate in the digital economy. When you partner with us, you're part of something groundbreaking. And I want to drive that point home. You as clients, or you as people who are participating in this, are being part of something that hasn't necessarily been done before. And that's tremendously exciting. And we have an opportunity together to create sustainable long-term wealth for you and your families while participating in the evolution of this financial technology. This picture was taken at the first Digital Fusion Summit that we had last year. These are many of our team members. And it's just a note to say that we like to have fun. We're a great team. I'm very proud of the work we're doing. And it does separate us again from the Jamie Dimons and the bankers of the world. I have fond memories of that evening, and I remember looking over at Jake at one point toward the latter part of the evening, and he kind of looks over at me and says, I think we have $500 billion of wealth in this room right now. And I was just blown away. I thought that was really amazing to see. So when we do a comparison about the things that are different between us and them from a client perspective and engaging with these strategies, the minimum entry for you as a client of DWP is just to be a client. We will take care of the rest in terms of aggregating the right assets and getting them to a place where we would be able to participate in these strategies. We will also not charge management or performance fees to clients regarding these strategies specifically. There will, however, be a subscription fee that is a modest 75 basis points that is used for operations, research, and the development of new initiatives designed to create additional returns. And I want to drive this point home just a little bit further here to say that these are really just meant to be a subscription fee net of fees. So you as a client would never have to come out of pocket to pay these fees. Any returns or distributions that are made to you would be net of these subscription fees. Our minimums here for clients and from a limited partner perspective will be as low as $50,000 per strategy, provided that this strategy aligns with your stated objectives and conversations with your advisor. And as part of being a Digital Wealth Partner client, you will have access to additional pipelines of opportunities as they get made available to you. We continue to provide institutional grade and insured custody for your assets. We provide investment advisory services and estate planning services in addition. So I hope this helps give an interesting picture about how we try to differentiate ourselves from others working in this space. And again, um, uh, nobody is really focusing on the digital asset space in this regard. If you brought a bunch of Bitcoin or XRP to an advisor, they'd likely tell you that it needs to be sold, and it likely doesn't have a place in your portfolio. So that's a lot of what we're hearing right now, and we just want to make sure that we're providing a different strategy for you to put those assets to work. Okay, now the point we've likely all been waiting for is the discussion about our investment offerings and what these are going to look like. I want to split these into two very specific different objectives. And we want to talk about one being asset income and the other one being asset growth. What I'm going to do is I'm going to dive into some details about each one of these respectively, and then we can, again, have a further conversation about them as needed. The target objective of the asset income strategy is to generate consistent income for our clients who are participating in this strategy. It leverages a market neutral algorithmic trading strategy to capture small gains in the market. And this strategy seeks to minimize exposure to overall market movements by balancing long and short positions. When we say it's market neutral, it's intended to work in markets that are down, sideways, or going up. So there is a very convenient longevity in terms of being able to use this product for the long term. It doesn't have to be a long only strategy or a short only strategy. It is market neutral. The cohort or the ideal group of investors that this strategy would be good for are those who are seeking periodic but not guaranteed cash distributions. Again, this is not a yield product. We are targeting between 5 and 10% annually net of fees based on historical data and market analysis. And the organization that we're going to work through, I'll talk about that in just a moment, but it's leveraging a sub-advisor known as Algos, and they have a strategy track record that has gone on for 5 years, 60 months, with 83% of those being positive months. And some additional highlights here that I'm happy to share. The best month they had in the last year was 11.9%. The worst month was just shy of a 1% drawdown. The average monthly return was 2.2%. The annual return was almost 30% and a Sharpe ratio of above 3, which was really amazing to see. One note here that we do have to make is that from a custody perspective, assets will leave Anchorage when they are placed in this strategy, just this strategy, and they will be placed with another custodian in cold storage. The assets in these strategies will not be rehypothecated, but they will be rehypothecated means that they won't be used or commingled with any other assets. And we just want to be clear that there will be a movement of assets to another custodian in cold storage. And we have confidence based on the vetting of this partner and this other custodian that this is a secure way to engage with this strategy. From an expected terms perspective, this is something that you can see. We have a few tear sheets that will be available for review and dissemination as people are interested to see more details. But this is at a high level the best way to think about it. When you look at general partner here, you'll see a familiar name, but perhaps a little bit different than you're used to seeing. Digital Wealth Partners Management LLC is a sister hedge fund that sits next to the registered investment advisor, and it hires the RIA to manage the assets in these strategies. So I am the fund manager for Digital Wealth Partners Management LLC. And so you just the only thing for you to know here is that there are two separate entities that will be handling this, but it's all under the same umbrella. So just something to be aware of. The sub-advisor, again, will be Algos. We are targeting about $250 million to be put into this strategy in aggregate in total. Again, we have a performance fee here. I have big apologies on my side. I didn't change this to say management fee. It should say subscription fee. So I apologize. It is not a management fee. It is a subscription fee of 75 basis points annually. Entry, we will be doing monthly closings for this, which means that at the end of every month or during a certain month, you'll be able to apply to come in, and then we will close at the end of the month and have a capital call so that your entry into the strategy would start on the first of the month. And then if you want to, go
Can I
ahead.
interrupt real quick?
Sure,
Just
Max.
because I keep getting emails and tagged in DMs and other things. I do not know and cannot answer any questions regarding digital wealth partner stuff. I have no idea. I will never have an idea. I do not know. So any of these questions, if you have them, it's best to email the team at Digital Wealth Partners to be able to get answers to those.
Thank you, Max. Yes, we will. We have some next steps for you coming forward that we will talk about toward the end of the conversation. Any questions you have can be directed to info@digitalwealthpartners.net as well. But I will get into that, and I will reiterate what Max said. Max and Future, to the best of my knowledge, don't necessarily know what's going on this side. So if you do have questions specifically, please reach out to the Digital Wealth Partners team. Thank you, Max.
Two things, if you could go over real quick for people just to clarify.
Sure.
The moving of the assets, which
Mm-hmm.
custodian, which I think you have listed down here at the bottom, which
Mm-hmm.
you may have been getting to, and then also, um, is this fee, the subscription fee is in addition to the AUM fee? Is that correct?
Correct. So when you're a member of the firm and you're an RIA client, you are subject to asset under management fees and you are subject to performance fees if your portfolio is above $1.1 million as stated by the SEC and the regulations regarding registered investment advisors taking performance fees from clients. If your assets are below 1.1 million, you are not subject to performance fees. When you are interested in participating in this strategy or either of these strategies, a 75 basis point subscription fee will apply. And that again is a result of us needing to, on the fund side, come out operationally to we have a large fund administrator that we work through. We have a lot of onboarding clients, and all these things cost money. So to keep the lights on for the fund, to be able to provide these kinds of strategies, to be able to look at new strategies for research and development, we're asking for a modest fee to be able to make sure that we can set that up and do this in the right way, so that you have all the right rails in place and the right mechanisms in place to take advantage of strategies like this. But those would all be net of fees. So you again would never come out of pocket to pay these. These are only paid as a result of distributions that are being made. So I think it's important to hammer that home. These are net of fees in terms of fees.
And there is no performance fee on this fund, so it's not like you're getting whacked twice, right? So like,
Correct.
normally in a fund of fund structure, even if you were at a family office level, you would have an RIA or somebody that, managed your assets that then put those assets to work in another fund. The other fund would take their fees, and then, if there was another in between, we're not cropping any extra fees here, is what I'm trying to point out. This is a very minimal, like Matt said. There's just hard costs with setting things up, and it's net of fees, so it is a fee that's associated, but there's no additional cost when contributing capital. So
Right. And when we look at the return profiles for these net of fees, you're still looking at, in this target between 5 or 10%. And again, that would be something you're putting assets to work that can't be put to work in another way. And so this is just something to keep in mind, that you're going to have access to something that doesn't exist, that nobody else is providing. And with an asset that doesn't have, typically with an asset that doesn't have, native staking or any other way to generate returns. So I hope that this all makes sense, and that if we have questions, we can certainly answer them. Good, Jake?
good to go. Yep.
Okay. The final thing on this one, especially from an income perspective, I know a lot of folks are going to be keen on understanding this, but I want to point out that the expected distribution here is going to be quarterly, and that serves two main functions, with a third being from sort of an organizational perspective and an accounting perspective. It's much cleaner and much easier from there. But for you as a client, it may seem like you want cash distributions monthly, but I want to explain why that's not super ideal in this situation. And I can do that with one example. So say, for example, you wanted, we were on a monthly basis here, and as I mentioned in this previous slide, though they did have a month that was a 1% drawdown month. In that instance, if you were doing a monthly cash distribution, there would be no cash distribution that month because the fund had a 1% loss. So if now you think, okay, we're doing this on a quarterly basis. Over the 5 years that they've run this fund, they've not had 3 months of consistent down months. So, if in month one it goes up, and in month two there's a small drawdown, and in month three it goes back up, you would be receiving a cash distribution based on the full 3 month performance rather than a single month performance. And we wanted to ensure that we could, as best as possible, generate consistent returns. And in order to do that, we have to expand that window a little bit to give them the opportunity to have the fund perform better in a month if they did have a down month. So that's the first one, is to keep them on a more consistent basis. We would do better by saying you can get them in fewer increments than on a monthly cadence. The other is that if you leave the funds in there for an additional month or 2 months, they have the ability to compound higher over time. So you might see a higher net return over 3 months than you would on a month-to-month basis. And so again, this is just two reasons why we've done this on a quarterly side. And then on our side, of course, there's like accounting and operations that make this much easier. But I do just want to come back and say that we are expecting those distributions to be made quarterly. I think that that's important to remember. And as Jake mentioned, the custodian here would be Bitfinex in cold storage in conjunction with Zodia. Again, these are vetted institutions, and we, in our due diligence, have felt comfortable with the what has been established from those relationships to feel comfortable placing assets there. If you as a client do not feel comfortable with that, we completely understand. In order to take advantage of some of these situations or some of these strategies, that is going to be a requirement that we move some assets off platform. So I do want to make sure that folks are aware of that as well. It also bears mentioning, at least at this point, we don't have a hard number yet, but we will have a maximum contribution limit that people can contribute based on their portfolio and based on their sort of investment objectives as well. So it's important to note that just because you might have all this capital that you have in your account and you want to get it all earning returns, we at the firm are going to have a maximum amount that people can contribute based on their overall portfolio, their overall objectives, their overall risk tolerance. And we as fiduciaries just have to make sure that 100% of your assets aren't in something that it is a strategy that has an additional layer of risk outside of holding the assets like you do now. So flipping the switch a little bit here to asset growth, you'll see this one is not based on income. This target objective here is to generate capital growth over time. So if you're familiar with dividend reinvestment programs or almost like a dollar cost averaging program, the idea here is to keep your funds in this account and let them grow and appreciate over time. The strategy that we are working with here uses a long strategy, means holding assets for a longer period of time, combined with algorithmic mean reversion strategies. Now, mean reversion is very esoteric finance term. I totally get that, but it basically means that you see spikes in prices go up and spikes in prices go down, but on the whole, they revert to an average. And the idea here with this strategy is that because we see how prices on average return to a historical mean, we can place investment bets strategically. So this would be for investors who are seeking to compound XRP or other assets over time. I should also just state really quickly that both of these strategies are fairly token agnostic. As long as it's supported by Anchorage, as long as you have them in custody, we should be able to place them as collateral in either of these strategies. I just put up XRP here because I know that that's really one of the largest holdings that we have. And I just want to make sure that people are aware that this is a way for you to compound that XRP. If you think about when we talk about compounding, if you gave us 100 XRP at the beginning of the year, when we compound that a year later, you might expect to have 110 XRP in your account, meaning you had a 10% asset growth over time, and that's denominated in XRP. The target returns here are higher than we would see with the income approach, and we're talking about 12 to 18% here. Again, these are net of fees, so that means additional capital comes over. There's fees that are associated with that. At the end of it, we expect to be able to produce 12 to 18% for you, again, net of fees. The highlights here have been pretty impressive. We did a back test track record with 2 Prime, who is another very well-known sub-advisor in the space. They ran almost a full 5-year back test track record on XRP specifically. And that back test record had 76% positive months. The best month was 24.5%. The worst month, this was minus 8%. Average monthly return was 3.3% and an annual return of 45% with a Sharpe ratio of just over 2.5. So again, this is a riskier strategy than the income strategy, but the risk return is a little bit higher here because of the way that they're going to put these assets to work using their long and mean reversion strategy. In a very similar way with the income fund, assets will leave Anchorage that are committed to this strategy, not your assets if they're just sitting idle in Anchorage, but if you do have assets that are going to participate in this strategy, those assets will leave Anchorage and will be placed with another custodian. And in this case, it is MirrorX, which you'll see at the bottom there. All the same pieces apply to the expected terms here. We'll see the sub-advisor is 2 Prime. We're expecting to raise the same amount of money for this. Again, apologies on my side for not changing this. It is not a management fee. It is a subscription fee at 75 basis points. It's the same for the other fund. Entry and exit, it's going to be the same. A monthly closing, 60-day notice. Investment requirements, $50,000, again, as we stated previously. Distributions are a little bit different here. Distributions are at the fund manager's discretion, or if you would like to leave the strategy. So ideally, this is not a strategy that you're in and out of very quickly. This is something you leave assets in for a year or longer and expect to see assets compound over time. If there are any reasons to have specific distributions or we need to do that, we can do that from a fund manager's perspective. But otherwise, the distributions you will get will be when you decide to leave the fund, and then you will have hopefully more XRP in than you put. I will move to the next slide here, which is to talk about our stablecoin fund, which we are hoping to launch in Q2 of this year. And we are going to be targeting returns at about 12%. And you'll notice here that this is a much more, I always say we talk about yield. This is something that we could potentially offer in terms of yield, but it's going to be focused again more on return. So there might be another sub-advisor. There's going to be other ways that we're trying to use stable coins, potentially RLUSD, potentially USDC, other ways that we can pull low risk capital in a consistent way for people to participate. Finally, I want to talk about next steps and how we can get you situated to participate in these strategies. If you're already a DWP client, we encourage you, if you have not done so already, to fill out your suitability form. That will really help us determine your suitability for these investments. And in the coming weeks, hopefully I'm expecting this before February, probably next week, be on the lookout for an interest indication email that will come from Digital Wealth Partners. What we're going to do on our side is intake the people that have filled out their suitability form, start to make sure that we've aligned with a group of individuals who we think these strategies would make the most sense for, and we will reach out to get more information about their interest. If suitable and if interested, we'll put together a subscription document for you that will allow you to determine the contribution amount and the desired strategy you'd like to participate in. And then when capital is called, you will be able to transfer assets from your Anchorage wallet to the fund wallet where those assets will be deployed for the strategy. If you were looking to join Digital Wealth Partners, we are very excited to have you. It's important that you contact info@digitalwealthpartners.net or use our contact us form to get started. You can get started by establishing your LLC, complete the onboarding process with Digital Wealth Partners. You'll go through an anti-money laundering and know your customer certification process. And then you'll be able to fund your wallet with our institutional and insured custodian Anchorage. To then, at which point you'll be able to fill out your suitability form as well to be considered for these other strategies. So with that, I will have this nice disclosure page up that is a lot of words, but basically just talking about things being a high degree of risk and all the work that we do here. And I'll leave this up and pause, and we can open it up for discussion, questions, anywhere you want to take it. Jake, thank you so much for the time, and I just really appreciate you all listening, and welcome all your feedback.
Yeah, thank you so much for running that down and putting this together for everybody. I think it's just a really good way to explain the offerings that currently exist. And to Matt's point earlier on in the conversation, we will continue to build out ways to be able to generate returns with the assets held with Digital Wealth Partners. A lot of these things literally don't exist. What we've created doesn't exist. Nobody else has access to this. It's been out of necessity. So, we had a conversation with Vet on Friday, just making sure that we're being proactive about, potentially integrating with the XRPL and being able to utilize the features that will be built out on the network to be able to generate returns and potentially yield for clients in the future. We're early, and I think we'd say that a lot here. But out of necessity, we've come to some solutions that we feel are very reasonable and ways to be able to get returns on the asset at the current time. So again, just appreciate everybody's patience. I also want the day to happen when there is zero risk for your assets and you're generating 5 or 6%. I think that we're close to that, maybe with this stablecoin fund that Matt mentioned at the end here. We're currently working through those deals. And again, there are risks that have been disclosed here, talking about moving assets off platform. If you're not interested in that, we are working on other things in the short term. What do you think? I can't give any promissory timelines on stuff, Matt, but you said kind of Q2 for the stablecoin. Are we looking to roll out some other options, hopefully where the assets remain inside Anchorage in the near future?
Yeah, so the one that I'm really excited about, and this is like a super nerdy thing to talk about, and again, this is still in the works. This is something we were actually, you know, I feel like it's okay to talk about this, Jake, but like there's something called an American depository receipt.
Mm-hmm.
This is
Mm-hmm.
a very boring financial topic, but basically it's a way for foreign investors to participate in acquiring stock that they can't necessarily acquire on a traditional brokerage and exchange. There have been Bitcoin denominated ADRs where people can take their Bitcoin, they denominate it in an ADR, an American Depository Receipt. That depository receipt gets a unique identifier that allows it to trade on exchanges and traditional exchanges like a Fidelity or a Schwab, which is really cool. And it's cool because it has the potential in aggregate to allow for what's known as a margin release, or getting a little bit of the ability to borrow against those assets. So we, in conjunction with a partner, have just actually, basically as of today, confirmed filings for the first XRP ADR that has ever been in existence. So there's going to be a way very shortly for us to aggregate capital in much the same way that we do for these funds, but instead of having the assets leave Anchorage, they would essentially stay at Anchorage in the fund, and they would be denominated one for one at a traditional brokerage. And if we did that and we were able to get margin release, we could, in effect, go buy US treasuries or start a treasury ladder or start some sort of low risk yield producing strategy using a one-to-one representation of aggregated XRP, all within custody. And again, this is like amazing to me because we're literally the first team that has ever done this in the world. And it would be a great way to be able to aggregate funds, keep them in custody, represent them somewhere else, and get a margin release on them to be able to put them to use for very low risk yield producing strategies.
Yeah, so that's on the short term time horizon here. We funded that deal. I met a gentleman at an event late last year here in Dallas that's what they've done, and we're working in correlation with them to get that across the line. So again, another innovative product, and that's again, just personally here, and I'm not trying to sway anybody one way or another. That's been my vision the whole time. assets stay secured, sat in custody. You have visibility of them. Very little, if any, counterparty risk, and we're able to generate returns on those assets in a sustainable way. So we are working toward that, but I know, people are eager to have some income off of these assets and positions that they've taken. And so we've, structured these partnerships and created the swim lanes to be able to offer that here in the short term through other means as well. So with that, we can go ahead and hop into some of the questions here. D Baker, I think, is kind of hit the nail on the head, and probably what everybody else's main concern also. He said, "Did I miss what is the risk to utilize these programs?" So if you could go over at a high level the potential risk or loss, risk of loss on working in this capacity.
That's great. And yeah, so those are important things to consider. So I'm going to hit the high levels here, of course. So if you're a client with DWP, it means that you've already assessed the risk of placing your assets in custody and institutional grade custody with Digital Wealth Partners and Anchorage. And for that, we are very grateful. To participate in this strategy, or either of these strategies as a whole, we have a few different specific kinds of risk that we need to address. The first is counterparty risk, the risk that these vetted sub-advisors do not perform well, or their strategies go completely bust and their strategies no longer work. Though they've had a track record, no past performance is guaranteed of future returns. So we have to keep that in mind. The second would be the platform risk. Are there issues with the platform that they're using, whether we're using Mirex or Zodia or Bitfinex? These custodians or these custodians share their own sets of risk, and we will be able to speak more to those in the subscription documents, and any documentation that we provide will have those in detail. So I think those are two big ones, right? Like the counterparty risk, the platform risk, and then the strategy risk. As I said, like if the strategy doesn't work, that is certainly a risk. When we talk about quote unquote loss of XRP, I want to be specific here in the way that we would talk about loss of XRP if there is a down month, for example. What's going to happen with these assets? They're going to be put in cold storage. So XRP is going to be housed in cold storage. It's not going to be used for anything. But what these sub-advisors are going to do is take margin against these assets and then put that capital to work using their various strategies. So if there is a down month, the sub-advisor will need to pay that margin or make good on that margin, bring the account back up to where it was previously. And to do that, they may have to sell a portion of the XRP that is in cold storage to bring that account back up to the required margin minimum. So that is, go ahead.
What if the XRP is appreciated during that time frame?
If the XRP is appreciated in that time frame, then all that will be required is for them to make the margin whole on dollar notional terms. So if XRP has gone up, but they have to fill the gap a certain amount based on a loss in that particular month, they would then need to use less XRP to fill that gap. It's all denominated in dollars.
Right, but I'm just saying they wouldn't be able to get a margin release to cover the difference if the assets had appreciated substantially.
That's a good question. I think that's very fair for them to be able to say that would be able to happen. But if you look at it from the perspective of if the asset price went down, or if the asset price stayed the same, they may have to sell some to make themselves whole on the margin.
Okay, it's good to know.
But again, but again, it's important to know that the strategies have had down months, yes, and everything does have a risk, yes. But over the 5 years that both of these strategies have been in play, the performance has been very, very good. We're not trying to, we've compared a lot of different sub-advisors, and we've looked at a lot of different ways that this could be used, and we feel very confident in their approach. Also, we are going to be sending out some updated, right now, the tear sheets that we have on the website are very minimal in terms of what they describe from the strategy perspective. And that's that's going to change. My goal is to have some updated ones with some additional metrics, some track records, additional ways that people can evaluate these opportunities with some more concrete data. So look for that in the coming weeks or week as well.
There was a comment here brought up by Squirrel Tribe. So with the covered calls and puts, there was a potential for a small portion of loss, if there was a big move higher in the asset price itself. Um,
Mm-hmm.
does that exist with these strategies?
No. So and that's a good question. The covered call strategies to sort of settle that point, there is the hash note strategy is still available. That is for qualified purchasers. You have to have 5 million in investable assets to be able to participate. Happy to provide any additional details on that for folks who are interested. That is open currently to folks, and we could have that conversation. That strategy uses calls and certain spreads to generate income from those assets over time. And there is the ability, or there is the possibility that if the assets appreciate sharply over the course of a contract that you have open, that there may be a small amount of XRP that had to be sold or called away, as it's known, to fulfill that contract. In the two strategies that we are looking to deploy in the coming weeks, both income and growth, those do not use option strategies. So in the respect that assets could be quote called away, does not apply for these two strategies. That's not the strategy that they employ.
Very good. Colorado says, will these same strategies be able to be used for self-directed IRAs? No.
Good question. At the moment, no. Correct.
Well, and maybe we should get into why that is. So you cannot borrow against the initial principal in an IRA. Again, once we have native ways to earn yield on XRP, either through Flare integrations there, or liquidity pools, or some other means for staking or restaking the XRP, I'm highly confident that those measures will be able to be used inside of an IRA to generate returns or yield on those funds. But currently, with the way the regulation sits, margin or you cannot borrow against principal inside of an IRA. So
correct.
Ames. So just to understand correctly, these current return strategies are only available for DWP clients who are accredited investors. That is correct. We are pursuing other options. We've had multiple conversations with legal counsel, the fund administrators, ad nauseum, potentially leveraging like a Reg D fund, similar to what we do here in the group, to be able to facilitate and, allow non-accredited investors to participate in the yield. It adds additional costs in multiple applications when we do that. That we need to flesh out, and it would be other costs to the investor that would have to be passed along. And so we're trying to find a happy medium there. We definitely want to be able to provide that for people, and we are actively working towards solutions, but it's not currently available.
Yeah, and it's something that Jake and I have gone back and forth on, and we've really looked at every way possible under the sun to try to make this available for non-accredited as well. And the bottom line is that these are the rules set by the SEC, and parentheses. Thanks, Gary. These these are the rules set by the SEC, and we as a financial institution regulated by the SEC must abide by these as best we can, and in accordance with their rules. And we want to kind of crawl, walk, run this, and make sure that we get this part right and buttoned up, and everything is good to go, so that we can ensure the longevity of the firm in terms of our regulatory compliance. So that's number one, making sure that everybody's above board in that respect.
Yes. Will insurance be available at the other custodians?
To my knowledge, no, but that is something I could certainly look
Zodia
into.
has insurance. We know for sure.
Zodia does, correct.
Bitfinex, yeah, I don't know about them, and Miro, I'm also not sure on. We will
Well,
verify and get
and
back to you on that question.
yeah, and we're also, part of the onboarding and arrangements we have with the sub advisors is that those sub advisors have insurance as well. So
Hmm.
this is something else to keep in mind.
Yeah, we have that in the contract with them. Squirrel
Mhm.
Tribe says, what is the typical ratio of DWP customers accounts being deployed into income/yield versus left idle in custody with Anchorage? I realize this is customer dependent and it's typically under guidance. Is it like 50 left idle and 50% put to work, or is it some other ratio? So I can
Oh,
speak to one specific client. Um, I can't disclose who it is, but that client borrowed against half their XRP and then put the other half to work. Um, and then that way they're able to, you know, service the interest or the debt with the returns on the other side and get a higher allocation to XRP. Um, so anyway, again, I think it's going to be very a specific depending on your time horizon, risk tolerance, and what you're comfortable with. Again, Matt kind of went through all of the risks associated with this, and some people may be okay with two of them and not with the third. um, what do you think you kind of envision? Is it like a 50-50, or do you think it'll be less than that, Matt?
so I was doing math on this over the weekend, and we're gonna work to put a policy in place. The number one thing that's important to remember is the allocation that we might cap at DWP is in relation to your overall investment portfolio. If you have a 401k, a traditional IRA, you have a bunch of other assets held in a brokerage account, you've got, Tesla stock, like whatever it is, we'll take that whole bit into consideration when we think about what a cap might be for a specific individual regarding their ability to contribute to this. If you've got a million in XRP and you've got 6 million sitting out elsewhere, it's a much easier conversation than I just have $1 million and it's all in XRP, in which case we might say, well, you can only put 20% to it or something like that. So it's really on a case by case basis. And I'll kind of just pause it there. But yeah, it's really just dependent on your full investment portfolio picture or sort of net worth picture.
Yeah. Um, they asked if they needed to bring an accreditation letter. Anything that's outside of the purview of what DWP has would require that. Um, so again, the suitability questionnaire, a lot of that's disclosed on there, and DWP could write you a letter of accreditation, depending on how much assets are, and then also if it's you already have your digital assets over and they're in excess of $1 million, then obviously you would qualify as accredited, and they could also write the letter for you. Um, Clay says ADRs. ADR is an American Depository Receipt. I think Matt did a good job of explaining that earlier in the call. If you want to listen back to the recording, he can kind of run that down. Phil, when assets are moved off platform, will that decrease the custody fee for Anchorage? So there is no custody fee. There is an AUM fee, which is basically for Digital Wealth Partners. We include the custody fee inside of that, but wherever the assets are sitting, there's going to be some type of fee associated, and so there would not be a reduction in the 40
Yeah,
basis
it's
points hike.
yeah, it's actually a really good question. I'm glad feeling lucky with they thought they were feeling lucky with that question. Like maybe they'll get a lower AUM fee for contributing to this. So we're going to do you a benefit so that we work with OnRamp to make a representation of what your contribution is to a particular fund and what the value of that is. So when we represent that, it will make sure that we've kept, we're not double counting certainly, but any assets that are put into these strategies will remain quote unquote under custody, just in terms of how it's viewed from Digital Wealth Partners' perspective. But you as a client would be able to see the performance and those assets um, appreciating in value over time. So that's also like just a note here is that this is not meant to be done in a black box. Like you'll never see these assets again. Everything will be done on chain. We'll be giving out reports on a monthly basis to talk about performance to folks who are aggregated or allocated to specific strategies. And so you'll have full view in terms of how these assets are performing and where they are at all times.
Yes. So a couple other here. George M. So am I correct in hearing that currently there is no option for returns slash yields for while in custody? So I'm assuming he's meaning at Anchorage specifically, and
Correct.
that would be correct. Currently, until we have the ADRs live here, hopefully within the next month, hopefully sooner. At that point, we'll be able to hold the asset there at Anchorage and then take that representation of value. It'll have a QSIP number. We can take it to Fidelity, Goldman, BNY, all these other large players, and potentially release margin against it. If things kind of unfold quickly now that Trump's in office and we get some executive orders or maybe regulation that allows XRP to be a tier one asset inside the banking system, um, I think the ADR will actually provide a really clean way to generate returns while the assets are held there in custody, and they won't have to be moved to Goldman, Fidelity, BNY. They'll sit right there in Anchorage, and that representation of value goes over there. So
Yeah.
that's, you know, we're working on it, George. I want it to be a thing, but we also want to be able to provide people returns in the short term for those that are working with us, and so that's why we've created the solutions we have.
And just also a note, it's not possible to do that in Anchorage right now with any asset. They haven't turned on staking capabilities for their wealth management platform. There are stablecoin rewards that are coming soon, and they're working on that functionality on their side. Anything we do to generate income on assets um, is being done because we're able to do that on our side. Even Anchorage doesn't have that capability yet, so we almost kind of want to race them to the ADR thing in some sense to be able to provide those kinds of yields. But I do understand that that's an important question to address, but it's not something that can be done in Anchorage anyways at the moment. So
Well, and again, I've talked about XLS64 with the pseudo accounts until May, June, July of this year is when those amendments are going to go live, and that's when I think a lot of the ways that I've been talking about generating yield for the past couple years will be much more attainable than how it works today with the red tape and just our partners. And it's not just our partners; it's literally the whole ecosystem. Um, Todd says, so for those of us that are not accredited, we have no options for now. You want to take that one, Matt?
correct. That is a true statement.
And again, working on that, um, dealing with compliance and the other partners I mentioned before to get something in place, but it does not currently exist.
Right. And what I would say too is as assets appreciate, or I would encourage folks to become familiar with how they could be considered an accredited investor. Sometimes it's just you need a better understanding of what assets count and what assets might not count. And one very, very clear cut path that is not income based is to hold a series 7, a series 65 or 82. I'm not not suggesting you go out and take a test to go solve this problem. But I personally do not meet the income requirements. And I went and got the series 65 and I'm an accredited investor. So that is a potential option for people if they are interested in pursuing that path. I just raise that as another option.
Yeah. Trent says, being a Carbon One member, are we considered accredited investors? No, you would be a sophisticated investor under the guise of what we are able to state for the financial education and business resources we provide here. In Europe, that is the same as an accredited investor, but the language here in the U.S. differentiates sophisticated versus accredited. Um, And I actually really like the way the UK puts this together for their sophisticated or accredited investors. If you've been involved in an asset class for longer than 2 years or held a vocation or job, it is part of your profession in a specific type of investment, you have a deep enough understanding in order to understand the risk associated with that and can participate in investments in that field. And I feel like a lot of people here have been here longer than 2 years in crypto and should be able to invest in fintechs and other companies that are associated with the space. But alas, until Gary's gone and we get a new SEC chair in there, that is one of the things that we would like to propose to them as a qualification for accreditation, and working with Jimmy Valley and a few others to do that. Carbon One Group at a minimum are considered sophisticated. That's correct. D. Baker, it may be helpful to see written out examples with easy math that show expected returns, then how risk would occur. So maybe some scenarios on these strategies, Matt, or like there's a chart. I know Aaron showed me a chart for their returns over the past couple years. I think that would
Mm-hmm.
be helpful for people. Um, there were, like they mentioned, a few specific moments when they had drawdowns, but by and large, when the market itself had significant downturns, they were break even on the month. It was almost like an IUL type chart, which was very interesting to me. Outside of the few circumstances where there were huge mass liquidations and liquidity leaving the market, they just had continued upside returns over the full term of these funds, which was great.
Yeah, and both of them are really intended to be market neutral or a little bit, longer leaning. So just from that perspective, like the design of these strategies is actually meant to reduce the risk, and provide consistent returns. It's not meant to be, y'all have already taken the risk in getting XRP and getting an asset. That's the hard part. Their goal is to then say, how do we take these funds, put them in cold storage, get margin against them, and then go put some strategies to work that we've produced previously and have a pretty good track record on, again, to generate consistent returns. It's not about ups and downs, back and forth, back and forth. It's meant to be in a tight window range of what those returns are, on purpose.
Mm-hmm. Kira's asked a good question. So he says, will AUM fees start when non-accredited investors' assets are literally parked at Anchorage, or will they begin once the assets are put to work? The AUM fees will be as soon as assets are moved into custody, they will start charging those. And I wouldn't look at it as, well, I mean, you can't. Like, I completely understand your hesitation to move assets over until there's a way to cover the fees. But I would just suggest that you're not getting only the returns there. We're providing a full scope of services, like what Matt mentioned at the beginning of the the uh, the talk there, all the different things that we provide that a bank doesn't. And that's really what that AUM fee covers. You're getting financial advice, the estate planning, you're getting the institutional custody with the insurance on the assets, peace of mind, beneficiaries designated. Um, there's a lot more to it than just. I hate raking people for fees. I've set this up in a way where I want to always make sure we're providing more value to the client than they are paying us. And so, we've done that with the grandfathered agreement here for a lot of people here in the group that got in, even with low values at a very, very low reasonable rate. Um, and I understand that some people are in financial positions where they can't afford the extra, and I don't look down on people for that either. So, anyway, just um, understanding of those things. I understand both sides of the fence and empathize for it. I would just encourage people to realize that it's a much broader scope of services outside of just the returns that will be regenerated on the assets. And we will have ways to do it for the non-accredited. It's just not currently available. It will be in the future. Um, there you go. Jim said the 75 basis points are only on returns, not in original investment.
Correct.
Quantum says both members of an LLC must be accredited in order to qualify. If so, is there a workaround? If the LLC holds more than 2.2 million in assets, it would qualify itself. Or it could be, well, there's one other exemption, but it's not going to matter. Do assets in IRAs count toward the 1 million for accreditation? Yes, they do.
Yes, they do.
Squirrel Tribe, for the client that you mentioned that took the loan against their XRP, can you disclose the interest rate? High to mid-teens.
Yep.
Is there a product feature service available for DWP clients, whether accredited or not currently? No. Accredited only at this time, but we are going to be able to provide that in the future again. Once there's native things to the XRPL, or there's reinsurance or other things, restaking is something else we're looking at. That should be available to all parties because it'll be the asset itself. It won't have to be put to work somewhere. Will you sponsor us to take the Series 7 etc. test? I was a financial advisor at UBS, but it's expired. Yeah, Clay.
It's a good question. Yeah, we totally would be happy to talk with you about it. I don't think that there's any reason why we couldn't do something like that.
Yeah.
And as I said, the 7 requires a sponsorship. The 65, it sounds like an odd workaround, but like it is a great path, especially as Digital Wealth Partners grows. Like we are looking for other 65s to be able to provide investment advice to people. So if you're interested in joining the team and you've got sort of the financial mindset to pass a 65, you not only get the benefit of being an accredited investor, but you get the benefit of come talk to us, see if you're a good fit for the team. I personally felt that it was an easier test than the 7. There's a lot less math on it. I think I spent maybe 2 months, got the book on Kaplan for $150 and sat down and buckled down and did some study time, and passed it on the first try. So it's a very unique way to become an accredited investor. And if you are interested, I'm happy to answer any questions about it. But there's a lack of them out there that understand anything about digital assets. The more the merrier at this point. So let's find a way to make that happen too.
A couple people, I guess, joining here at the end with the inauguration. This is recorded and it will be available later. It'll be in the All Recordings channel over there. And again, if you have any questions, you're more than welcome to reach out to info@digitalwealthpartners.net. Just want to thank Matt again for his time today. We can work with international clients, TO. If you are accredited in your jurisdiction, happy to have a conversation about that. But yeah, like I said, this is recorded, will be available for people later on. And just again, thank you for coming and spending time and explaining all this for everybody here in the group.
Thank you all for paying attention and giving us your thoughts and feedback. And again, I want to just reiterate that this is something that both myself and Jake are incredibly passionate about. I can't believe that we're actually on a path to providing these opportunities for folks. I know that there's going to be some hurdles here, or some it's not necessarily going to apply to everybody at the moment, but we are looking again towards asset appreciation and a lot of things coming in the future to be able to fill any of the gaps that we're finding right now. So hopefully this is able to provide a ton of value for folks, and we really look forward to rolling this out. And just a final note that again, I thank you personally for being a part of this, and just the fact that this is pretty revolutionary in terms of what we're doing, and you get to be a part of that. So thank you for your attention and time, and hope you have a great rest of the week.
Yeah, absolutely. So with that, we'll go ahead and wrap it up. I hope you have a wonderful rest of your Monday. Exciting times here with Donald Trump being inaugurated today and the new Congress coming in. Very hopeful for regulation and this new administration to foster the growth of crypto. I know that we're all here for it and should see a lot of upside in it. So we will be back Saturday at our normal time for the next town hall. And I will have the lives in the evenings this week if you guys want to hop in there. So, but until then, again, wish you guys a wonderful day and a wonderful week, and we will see y'all on the next one.